You think now may be a good time to buy and that people are making a mistake if they're underweight equities? Why?
Yes, I think so. Well, I think one of the reasons we had this correction, macro uncertainties, also reflects the fact the Fed was too tight last year, and they have changed that. They're starting to ease. So with a lag, say 6 months from now, I think we'll see economic growth start to pick up. Stocks will follow. So I think now is a good time. We've had a 5 to 8% correction in a lot of sectors. That looks like a pretty good bargain to put money to work in here.
Olivia, you tend to think, however, I believe that there's not that much that's actually cheap in this market. Is that true?
That's correct. I think this is really the time we want to be focusing on defensive quality, but not overpaying for it. There's a lot of things that are cheap in the market, but I think they're cheap for a reason. So we're trying to find, and it's a challenging job to find the names and the segments of the market that are reasonably valued, but providing some cushion against this late cycle, macro-driven, volatile market.
All right, so cheap for a reason is what? Is macro-driven and sort of what sectors of
late
cycle sectors? Or
possibly banks and autos are in that category, given the interest rate cycle, given the trade wars. It's too early to be piling in there. I think where we can find better value in names that are going to be more stable. We think that there are names in the traditionally not so defensive parts of the market, like in the consumer discretionary part. We've got the restaurant sector. You were talking about picking within the restaurant sector in the previous segment, but we actually think when you're looking for characteristics of sustainable growth, as your previous guest was saying, the restaurant sector really shines in that category. Also in the tech services segment, it's not so exciting as the high-flying, really expensive tech categories, but it's a much more defensive play, and you can find reasonable value there.
Margie, I'm curious what you're seeing within Wells Fargo itself, since I would assume you have a view on that, in terms of people staying out of equities or being perhaps reluctant to make the allocation that their advisor might advise.
Well, we see investment advisors very positive about the market, and actually their clients are too. A lot of the advisors walked their clients back from the ledge when we had that crash in December. When the market bounced back, a lot of advisors got a lot of credibility. People missed that. So people are much more optimistic, I think, than they were in previous slowdowns that we've seen.
Olivia, how do you think about the strength of the U.S. consumer and how much staying power that has to keep us from turning lower in the economy?
I think it would be dangerous to be betting everything on the U.S. consumer being super robust. So I actually think it's better to have offsetting positions that are going to be resilient in the effect that there is a recession. I'm not saying that we're in an imminent recession, but the market is going to react as though there is one going to happen from time to time, and so we just don't want to have that volatility in equity portfolios. That's why we're looking for the sustainable growth at reasonable valuations.
Margie, that's certainly, the viewpoint of a lot of people who say, let's just avoid the volatility in equities and try to find some value in either corporate debt or fixed income. I wonder, to what degree are you trying to play around stocks in particular?
Well, we're not too worried about short-term volatility. As investors, we're really looking for long-term wealth creation stocks that have sustainable growth. And within fixed income, we do think that the high-yield market in the U.S. looks very attractive for the fixed income investor. Yields of, say, 4 to 6.5%, a huge premium over treasuries, and defaults running under 2%. We think that will have modest returns, less than stock, but for the fixed income-oriented investor, we think that's a pretty attractive place to be right now.
So again, I guess, Margie, to end here, you see the risk being overstated in terms of the equity market, broadly speaking.
Yes, I do. I think it's a little bit of wishful thinking to hope we have a recession so we can pile in and buy stocks down 20%. This looks pretty much like the kind of corrections we've had over the last few years, 5 to 8%. The economy is too strong and too sustainable to have a recession and a big stock market crash, we think.